Hello, today in HKR 3100, we're going to speak about balance sheets and statements of financial position. Same thing. I'm going to be explaining to you all the various terms that go with this. Please note that on the course shell, there is Understanding Balance Sheets Terms. It's a PDF with a table with all these terms all laid out nicely for you, for when you're studying for the exam or doing the case study. So last unit we talked about the types of financial statements, that there's budgets, we have balance sheets, income statements, statement of cash flow, and statement of changes in net assets. And today we're obviously focusing on balance sheets. So we spoke about in the nonprofit sector and in the public sector. These are called statement of financial position. And just to make it confusing, in the US, for the public, government sector, the balance sheet is called a statement of net assets. So, balance sheets. As we've previously discussed, balance sheets are financial statements that show the financial condition of an organization. It's looking at assets, liabilities, and then equity, the worth of the company. The purpose of it is to show the proportion of assets, liabilities, and equity. It's called a balance sheet because ideally you're wanting these things to be balanced. Therefore, you're not, you don't want your assets to be less than your liabilities. Balance sheets are often reported monthly, especially in the private sector, and obviously this has to be done annually for nonprofit and government. So in the private sector, balance sheets primarily involve then the information on them as assets. These are current, fixed, and total. Liabilities, which includes short and long term, and then there's equity. As I mentioned, in nonprofit, this is called a financial statement, a statement of financial position. So it's a balance sheet in nonprofit. It contains assets, liabilities, but instead of it being equity, it's called the fund balance. Because why? Well, because nonprofits aren't allowed to make profit. So the same type of information is provided on a statement of financial position. So you have current assets. In nonprofit, that's cash, investments, and pledges receivable. And as you can see, it's not equity, it's called a fund balance. So in nonprofit, the statement of financial position differs from a balance sheet. As I've mentioned a couple times already, it's called net assets, not equity. It has cash. The current assets are cash, investments, and pledge receivable, which is similar to accounts receivable. I'll speak about that in just a moment. Each category has its own separate statement. So in nonprofit, each of these different categories and funds have their own separate statement. They separate the funds to show transparency. So you have the unrestricted funds show the financial condition of operations. The temporary restricted funds, show how much money is being raised. And restricted endowment funds show groups of how much money is available to support, operations. So again, net assets then is simply the difference between assets and liabilities of a nonprofit. If it's a positive number, it means that the assets are greater than the liabilities. In contrast, if your liabilities are greater than your assets, you'll have a negative net assets. Net assets, by the way, aren't owned to anyone. They only reflect the difference between total assets and total liabilities. Pardon me. So as I mentioned, in nonprofit, we have current assets, and we also, part of that is pledges receivable. So pledges receivable are like accounts receivable, things that are owed to you, but this is donation commitments made by nonprofit. So for example, I might have pledged a donation to a nonprofit organization that I'm going to give them $25 every month. Well, that means that, they have that as pledges, pledge receivable that they're expecting to be getting. So this is an example that's in the textbook, looking at a nonprofit for a children's discovery museum. And here you can see that it's got the unrestricted, the temporary restricted, and the permanently restricted. Different funds, and they're all like different balance, sheets, statement of financial position for each of these funds. Here's another example of a nonprofit. Pretty simple, but here you can see they have the general fund, a restricted fund, and a capital asset fund. And this financial position statement, as this one does, it generally shows a couple of years, at least, the current and the previous year. And then we have, again, for government, for public, they also have statement of financial position. And it's, again, very similar, except, again, it's not called equity, it's a fund balance. So statement of financial position, again, it's a reflection between the assets and liabilities, and it's a reflection of the wealth of the government entity, like the province or the city. They're very similar to balance sheets and similar to financial statements of nonprofits. They always have current assets, current and long-term liabilities. They have different fund balances, so again, because they're not using the term equity, and they have multiple funds, like a nonprofit accounting. How are these different from balance sheets? Well, the one thing is that in this case, in the public, they do show depreciated assets. Also, they combine all the proprietary and government fund balances into one report. So again, it's quite similar. They do use a different type of accounting, of course, in public, but non-accrual accounting, but otherwise they're fairly similar. So here's an example from the textbook of a city in New Jersey. You can see here they have fairly similar types of information, but here they've got sort of primary government, so that's government activities. They're showing like business type activities and the total. Not really sure what component units are, but just obviously these are all different types of units or and funds that go with those different units. Here's the town of Stratford. That's in a small town, I guess, in Kitchener, or sorry, in Ontario. And in this case here you can also see same type of information. They have their assets and liabilities. Now they're calling it surplus here rather than, it's not equity. And because they've made a profit, I guess you would say. And here they're showing multiple years as well. So to understand all these terms and the numbers and what they really mean, we're going to focus on balance sheets for the case study. As I've mentioned, the nonprofit and public financial statements, the statement of financial position, are very similar, but they're a little more complex. And I feel, for this year, let's just focus on really understanding balance sheets, and then you can, it's fairly easy to transfer that skill then to nonprofit and public sector. So for this lecture, you'll see on Brightspace, I have a case study, Fitness RS. So you can open that up so you can actually see the numbers there a little bit better. So I'm going to be going through, like, breaking this balance sheet down, and we'll while we're doing that, I'll explain what each of the terms are and what the numbers mean. So the first part of a balance sheet is assets. There's two types of assets. There's current and fixed. So current assets take a modest amount of time to convert to cash. In contrast, fixed assets can't be converted to cash very easily. And just, as an example, think of things, your house or things you have. So things that you could very easily sell. So you could perhaps quite easily sell, like, canned goods or things that you have in your house. Whereas things like your actually, like, let's say you owed money and you needed to sell something, well, it'd be very difficult to convert, for example, a house into quick cash. You got to sell it and all that. So they're viewed as fixed assets because it might take it harder in order to convert into cash resources. So you can see on the balance sheet, assets are divided into different parts. You have current assets, fixed assets, and then there could be other assets. Other assets are often more, to do with, could be like shares and all this sorts of thing. But we're not going to be getting quite that detailed in our example. So here we have current assets. So current assets consist of cash and cash equivalents, short-term investments, accounts receivable, and inventories. And so cash and cash equivalents consist then of the actual cash on hand, like maybe like in your bank account or cash box. This is like cash that you can, like, get out really fast. Then we have short-term investments. These are investments that would mature or expire in 1 year. It's important. So these would be things, for example, let's say a GIS or some sort of, like, investment that you have, or a bond or something, and that is you've invested and it's going to be done and mature, and you'll get your investment back within the next year. Accounts receivable are simply then the monies owed to a company by other people. So it is, you've provided a product or service, and this is what people owe you. And inventories then are the supplies and materials a company has on hand to manufacture its products or services. So like the resources that you use to actually make things. So in this case, we're looking, this is a fitness organization. So you can see here that right now they have $100,000 in cash. Okay. So can easily, liquidate that if they have to pay for anything. The organization has no short-term investments. So they have no investments at all that are going to expire in 1 year. And we can tell that by the little dash. That means not applicable, nada. And then we have accounts receivable. So again, that's money owed. So that means that $220,000 are owed to the company. I'd like to point out what bad debt is. Bad debt is stuff that is not going, you're not going to get paid. okay? So I'm just going to think of a library here, okay? Pretend bad debt is then the money owed to libraries for overdue fines that they know that they're never going to get back because the person's just, either going to stop going to the library. They'll never get that money. So that's bad debt. Think of it like, we all have friends, or family. You might loan someone some money, and there's certain family and friends that when you hand that $20, that you're just saying goodbye. And so that's bad debt. So net receivable is the payments owed to a business minus bad debt. So how much money you're assume you're going to get back minus how much money you're never going to get repaid. So in this case, they don't have any bad debt, so that's good. And in terms of inventories, they have then $2 million in inventories. So sitting somewhere in a resource, this is a fitness organization, they have that much money in supplies and materials. And that means like tangible things. So a couple of things that is interesting when we look at these numbers then is, as I've mentioned, we might ask ourselves, does the company have any money owed to them that likely won't get repaid? And the answer would be no, because from this you can see they don't have any bad debt. We can also, as I said, look at the inventories. You don't want your inventories very high, because when you have a lot of like overhead of resources and stuff, it costs money to house it. You got to store it. Think of like a grocery store. They've got to, keep it cool or freeze. So this is, you don't want to have high inventory. So maintaining low inventory levels help. And this is called inventory shrinkage. Don't laugh too much at that. So you want to avoid inventory shrinkage, which is the reduction in the value or amount of inventory due to unexplained reasons. For example, you could have a whole bunch of supplies, and someone might be stealing them. So if you kept your inventory low, people wouldn't be able to steal as much. Or for example, I'm sure some of us have done this in our households. You buy something that's on sale, like groceries. You buy a whole bunch of it because you're excited for the low cost. And then you've had it in your cupboard for so long, and, it's expired. So obviously it's reduced in value. It could also be things like, there are things on the market that might go up and down in terms of value. And this also helps you to avoid obsolescence, which is when something becomes outdated or old-fashioned to the point of not being useful. When you might have technology things, or like there's lots of examples when things might just become so outdated. And I think of myself like cleaning my office some years ago. All the things that are outdated. I had acetate slides and, all these things, the technologies that would never aren't going to be used now. And obviously the main point of keeping your inventory low is that it reduces cost and shortage. So now we need to consider the fixed assets. So fixed assets are, things, that are not, they're things that then are not easily converted into cash. So this includes things like property, buildings, equipment, and goodwill. And fixed assets are recorded at their original cost. And you have to remember that even though land and buildings tend to depreciate in value, meaning they become more costly to replace as the years pass, their value is not increased to reflect that depreciation. Instead, some fixed assets, such as buildings and equipments, are reduced in value as the years pass because it is assumed that they will wear out. So here, in terms of Fitness R Us, you can see that the fixed assets include property, buildings, and equipment, but there's no depreciation cost there. Well, what does that mean? Well, I might ask you, for example, what percentage of this company's fixed assets are coming from land? And without doing any math at all, you can just look at this and you should be able to tell me it's 100%. Well, how would you know that? Well, you would need to know A, that the company has zero depreciation of assets on the balance sheet. And you would have to know that B, land does not depreciate. Pardon me, I have a typo on there. I say appreciate instead of depreciate. So since they have nothing on the depreciation line of the balance sheet, it means they don't have any assets that depreciate. They don't have any equipment or buildings. And therefore, it must mean that 100% of the fixed assets have to come from land. Just a bit of a side, obviously, in this case, there is no depreciation value, but I want to explain how depreciation of fixed assets are calculated. So you have an annual depreciation value, and that equals the original cost minus the salvage value. That's a term for like what do you think it's going to be worth at the end of its useful life? And this is divided by the expected life. So how long will this asset be useful? I'll give an example. So let's say we're a company that we have a smart photocopier. So that means, color, faxing, scanning, talks to you, all that stuff. And in this case, then our calculation is the depreciation value equals the original cost minus the salvage value divided by its expected life. And in this case, the company originally bought the smart photocopier for $3,457. And we believe that at the end of the photocopier's life, we can sell that. At least we'll get $500 back, maybe for parts or something. And we believe that the photocopier is going to last for 4 years. That means that every single year of that photocopier's life, it depreciates in value by $739. So what companies do then is for every single piece of equipment and every building a company owns, there is an individual depreciation schedule that needs to be maintained. So that means that the fixed assets change over time. Like each year they're different because the values are different for things that depreciate. But always remember that land is never used up, so it does not depreciate in value. We then have our total assets. So total assets then are just the sum of all your assets. Total current assets plus total fixed. And so you sum that all up. So in this example for Fitness R Us, taking current assets and then add that up with the fixed assets, and if there's any other assets at all, and we add up to a number. And apologize, I realize I have the wrong example here on my slide. And then we have liabilities, and we can look at equity. So let's first just break it down with liabilities. So debt obviously is a liability on a balance sheet, offsetting assets, and liabilities reduce the equity of an organization. And I just want to point out that interest is not recorded on a balance sheet, although it is an expense, like if you're paying interest on a loan. So liabilities, as you can see from the fitness are us, we have current liabilities, fixed liabilities, and then total. So liabilities are typically looked at as short-term and long-term liabilities. Short-term liabilities include accounts payable and short-term loans. Long-term liabilities include long-term loans and also bonds issued by the entity. So that's for public organizations, companies that have gone public. So let's first look at the short-term liabilities of Fitness RS. So this consists then of accounts payable and short-term loans. Accounts payable then are monies owed to other companies for products or services your company purchased from them. So, do you owe any money? Okay. And so you have, in this case, the Fitness RS owes $170,000 to somebody. Then there's also short-term loans. So these could be like promissory notes, lines of credit, things to do with the bank, like financing. So in this case, the company actually does not have any short-term debt. And obviously then to get current liabilities, so current liabilities are things that are typically owed within the next, less than 5 years. And you just simply add them up. So total current liabilities, you sum up all the different current liabilities to get your number. Then we need to look at long-term liabilities. So this consists of long-term loans and like bonds and that kind of thing. Long-term loans is any money that is that the company owes in a 5-year period or longer. So that's important for you to understand. Short-term for liabilities means in less than 5 years, and long-term is more than 5 years. So, think of yourself personally. You might own a car. Maybe in 4 years, you have to, your loan is due. So that would be a short-term loan. Whereas a mortgage is a long-term loan because, you're paying it for many years. So in this case, Fitness RS has some sort of long-term debt, quite a bit, $1,700,000. And then obviously to get total liabilities, it's just the sum of all the liabilities. You take total current liabilities plus your fixed liabilities or other liabilities and add them up. And in this case, the total liabilities ends up being $1,870,000. And the last thing to look at is the bottom line. What's this all say? Well, we're looking at equity. So equity is the total assets minus total liabilities. And so what we want to do is, I'm sure you've heard, the books, the books were balanced. I know you hear that in movies. Are the books balanced? So, all big, accounting thriller movies always start like that, I found a discrepancy in the books, that kind of thing. So, when we're looking at a balanced, it's simply that do the total liabilities plus equity equal total assets? So assets should equal total liabilities plus equity. And in this case, the books are in fact balanced. So that's the end of just understanding balance sheets and financial statements. We'll be doing another in-class case study prior and then and also going over the case study that you have for your assignment.